report. We're seeing Treasuries come under some pressure as the 10-year yield edges up to 4.37%, but yields hit their highest level of the year early this week with the 10-year top at 4.42%. Joining us now is Kelly Kowalsk, MassMutual Portfolio Manager. Kelly, it is good to see you. So let's start with that jobs report. You call it a blowout number, Kelly. Were you surprised by the strength you saw there?
Good afternoon. Thanks for having me. Yes, I think we were thinking there may be some slowdown from February, but certainly a strong report, strong revisions, which we've been watching. We saw growth across cyclical and non-cyclical sectors. So really tells us not a lot of urgency here for the Fed to begin reducing interest rates looking at this report.
And if that's the case, I mean, I think you think that the markets are perhaps getting the Fed wrong here. In what sense?
Well, they've consistently gotten the Fed wrong, I think, for, going back several months. If we go back just 2 months ago, there was a certain probability that the Fed was going to begin cutting in March, and they've gotten that wrong. I think there is still the hope that we're going to get that 3 cuts this year. That's probably not a unfair estimate. That's certainly possible, but we do see a risk that we could see less than 3 cuts this year for sure.
So I'm thinking about the Fed's rate path, less than 3, Kelly, and when do you think they might start cutting?
Well, right now, the base case for the market is June, and there's about a 50% probability. Between now and June, we have 2 more payroll reports and 3 CPI reports. So that does give us enough time for them to assess more data. They've told us they're data dependent. So I think our base case is probably second or third quarter that they would want to get that started, assuming that we do see a little bit more progress on the inflation front, which is very important.
And even as the market is pricing in cuts that are still coming, bond yields have been actually rising a bit this week. We saw a couple of weeks ago a big move upward, another big move upward this week. So what do you make of that move, and how far do you think that can go?
Yeah, we have seen this consistently repricing. I think the markets have been very reactive to single data points. If you look at the ISM manufacturing economic data that we got earlier this week, there was a big reaction to that. And then you sort of had counter reaction with the services PMI. So I think the markets are a little bit too taking on sort of one data point at a time. But I think the point is that we came into this year sort of thinking that we were going to get way more cuts than we're probably going to get. And we're kind of seeing that sort of correct itself.
So Kelly, for fixed income investors who are listening right now, where are the opportunities in your opinion?
So we at MassMutual, we are bond buyers. We back insurance products with fixed income. We're very focused on high quality. And if you look at investment grade bond yields, you can earn 5.4% and lock in a pretty attractive sort of 7-year duration. So we like staying high quality investment grade bonds, so think single A and triple B rated bonds, and sort of staying in your short to intermediate tenors. We don't think you're getting paid a lot for going down much in credit quality or going out on the curve. So that's really where we like and where we think is a good spot for most investors.
So Kelly, we talk about the Fed day in and day out. The market focuses on the Fed day in and day out. In terms of what people are maybe not paying enough attention to, maybe we're too Fed focused. I know that you're looking at sort of the fiscal position of the United States. What do you think specifically we should be focusing on there right now?
That's a great question, because everyone is asking, why hasn't the economy slowed if the Fed's been hiking interest rates so much? And that's because the government is actually working counterproductive to what the Fed is doing and stimulating the economy right now. So we see that as sort of a risk when we think about volatility in Treasury yields and the reception to auctions. We did see it have an impact sort of last year in the third and fourth quarter. So we think that the unsustainable fiscal position of the U.S. government is a risk, and something that we should think about as we think about the premium you're pricing into sort of long dated Treasuries and U.S. government debt.
And with the presidential election coming this year, there has been a little bit of reporting that voters are paying a little bit of attention to this issue. But as we've seen traditionally, there hasn't been any real meaningful movement on this from either side of the aisle. Does that change this year? I know you're not a political analyst, but from the market's perspective, any chance of that this year?
So we think the election is certainly going to introduce some volatility into the market. We don't see it really materially changing what's going on in Washington. Unfortunately, our country is very divided right now. It's probably, may even get worse with the election. So we think it's probably not going to certainly help the fiscal situation. But we do see probably a certainty for volatility in the second half of the year.
All right.
Thank you, Kelly. Thanks for joining us. Have a great weekend.
Thanks. Take care.